Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In today's video we are looking at 5 different companies that could potentially be a great addition to your portfolios. But obviously I'm going to give you an overview, and then if you're really interested in any of these companies, then you're going to have to do a little bit more research and find out each one of these companies in more details if you like. Okay, but before we do that, I'm just going to share with you a couple of things that I'm looking for. So some of you are probably new to the channel and you haven't seen me do this, so I'm going to quickly give you an overview on some of the things that I normally look for when I want to invest in a company, right? So these are the 10 key attributes that I'm looking for, and then there's a couple of for the dividends if you like. So I'm looking for earnings growth, I'm looking for revenue growth, I'm looking for net income. These 3 things are important, okay? So especially when it comes to the revenue and the earnings as well. And the net income obviously is where after the company has actually paid off all the taxes and all of that stuff, is basically the money that's left over. Okay, we're looking for good profit margins, about 15% or more. We're looking for return on equity 15 or more. We're looking for growth in terms of free cash flow here. Now free cash flow is really important, and I always talk about it because it is really important. It's important to dividend investors because that's how we get paid. Obviously at the same time, the company can buy other companies, they can reinvest in the business, they can pay off debt, they can actually buy back their shares, they can do a lot of things with that money, which is very good for the investors. We're looking for companies that are undervalued, and then basically based on the discounted cash flow model. Okay, a lot of the companies that I use, especially Morningstar, uses discounted cash flow model to find the intrinsic value of a business and tell us exactly how much the price of the stock's worth based on the underlying business. Because remember, in the end of the day, we're buying a business and that business sells things, right? So we want to know how much should we pay for this. Now again, this is a estimation, right? This is an estimate. This is not accurate. They might not get it correctly, so that's why sometimes you have to basically be careful, and that's why I like to give myself a margin of safety when it comes to the discounted when it comes to looking at undervalued stocks, right? Strong balance sheet that has less debt, for example, have an excellent net income, excellent revenues and earnings and so on. Okay, we're also looking for companies with a competitive advantage, or what Warren Buffett calls moat. Okay, and that is companies that have basically kind of monopolized in their own markets. Okay, so in case it's just a new shiny company comes in, obviously they have a excellent product, maybe they have very sticky kind of business, maybe they have actually great customers that have stayed with them for a long time. Whatever the reason, they have a moat in terms of these things. All right, then we look for growth prospectus. Okay, this means, for me, this means the company, is it growing their revenue basically in the next few years? The earnings, is that growing? So if it's growing maybe 3%, 4% for consumer staples, tech companies, maybe 10% or more, depending on basically the sector that you're looking for, because you can't expect companies like Unilever to grow 20%, 30% basically in terms of growth and earnings growth every single year. So you have to be realistic, and you have to look at the sector average and so on. The other thing I look for is dividend yield. Okay, so the dividend yield, maybe I'm flexible when it comes to this. All right, I do have in my portfolio some companies that are less than 1%, so I am flexible because of my age and so on, because of my time horizon. In terms of dividend safety, we're looking for about 61%. That is the minimum I will look for normally. Okay, I do own one company that has less than that, and that is Rio Tinto. But because they do have excellent free cash flow, I don't think that's going to happen. They're going to cut it. Well, they did cut recently. Okay, and that's quite normal for those type of businesses. But normally for the blue chip companies, I'm looking for 61 or more dividend safety, if you like. Payout ratio, we're looking for less than 60%. Okay, the reason for that is because a lot of the net income, okay, goes to the payout of that dividends, and you don't want the company to use all your net income to pay you dividends, and their company has absolutely nothing left over after whatever, right, after you've got paid. Dividend streak, we're looking for about 10 years or more. Okay, some companies, obviously newer companies, might not have that, and that's normal. So again, you have to be you have to look at your time horizon and think about that. Dividend growth the last 5 years, so I'm expecting 7% or more. 6% is okay for me as well. Okay, so the last 5 years, if the company has increased 6% or more, hopefully they can do that or better in the next 5 years and so on. Okay, that's the reason I look at it. So these are the things that I look for. There's a million other things you can look for in terms of based looking for quality companies. So you're just gonna have to build your own list of things that you're looking for, and then basically when you do your analysis, just pay attention to the things that are important to you. Right, let's have a look at the first company we're looking at today, and that is a company called Robot Technologies. This company is in the information technology and a little bit overlaps with the industrials. Okay, they have create a lot of software, network software, system software, technology enabled products and so on. Currently trading $408 per share. EPS right now is $26. Market cap of $42 billion, and it has a wide economic moat. In terms of beta, it's quite low. Okay, PE is 15. Average for the last 5 years is almost 30, and price to free cash flow is almost at 31. Now the sector right now in terms of PE, we're looking about 25. So the technology sector, the S&P 500 right now is trading about 25, which is quite high if you think about it, but this actually is trading way less than that. But when you look at free cash flow on average over the last 5 years, okay, that is also tells me this company is really especially this tells me the company is undervalued at the moment. Annual dividend yield, we're looking about 0.61%. Payout ratio 16. 5-year growth rate is 13%. Dividend growth streak, we're looking about 29 years. Now 29 years means basically 25 or more is a dividend aristocrat, 50 years or more is dividend king. So this is a dividend aristocrat, and 98% of dividend safety, which is absolutely brilliant. Free cash flow, we're looking at $1.3 billion right now. Profit margin 51%, operating margin 25%, return on equity 22%, total return in the last 10 years we're looking at about almost 15%, and it has enough money in the bank to basically current ratio, enough assets to pay off their liabilities, their current liabilities if you like. So really profitability side of things is really good. Now when we look at the next 5 years, we're looking at about 8.85% growth every single year of earnings growth. And then Simply Wall Street is actually saying about 10% undervalued. Fair value $445 per share. Morningstar valuation 24% discounted right now. Fair value of $510 per share. Tip ranks 15%, 464, 491 according to Yahoo Finance, and according to Tip rank right now it's a moderate buy. Now the next thing we're going to look at, so this is really good. So every single company is actually one of these analysts websites actually have agreed this company is way undervalued at the moment. And the next thing we're going to look at is their total revenue over the last 5 years. So from 51 to $60 billion right now. So from 5.1 billion to $6 billion right now, which is really good. Like every single year they grew this revenue every single year. Even during the COVID time, they were growing that top line, which is really nice. In terms of net income, from 944 million to right now $2.8 billion, which is really nice, and 1.37 in terms of their free cash flow to right now 1.37. But they had a decline in 2021, so that would be interesting to find out why that is. Is it because some sort of a COVID related situation, whatever it is? And in terms of shares basically outstanding, this company surprisingly is actually diluting your shares. So if you own this company and you bought one share, that share is not worth what it was before because you've been diluted by the company. So I don't like that. Okay, especially a very old company that has been around for a while, it's got a great balance sheet. Why on earth are you actually diluting those shares? It will be interesting. Maybe they're acquiring other businesses. It will be interesting to find out a bit more on why that happened. So if you were interested when you did that, you will actually look at their financials a little bit more detailed, I mean. Right, so the next company we're looking at is Texas Instrument. This company is actually a semiconductor. They do a lot of the analog chips and so on. They love calculators and so on. And right now, They're trading $168 per share, EPS of $9, $149 billion of market cap, and it has a wide economic moat and beta that is quite lower. In terms of all tech companies, actually not bad, right? So 18p, 23 average P for the last 5 years, price to free cash flow 25. Again, like I said earlier, to technology companies right now are trading about 25, so it's actually cheaper in comparison to the sector. Annual dividend yield, we're looking about 2.73, which is really nice, sweet spot, really good. Anything above 2, basically below 4 is perfect for me anyway. Payout ratio 48%, nice. 5-year growth rate of 21%. 33 years of increasing that dividend, so they are dividend aristocrat, and dividend safety is 90%, and they have $5.8 billion in the bank to pay us whatever. Profit margin 43%, operating margin 51%, return on equity 63%, total return of the last 10 years it's 20, which is really nice, almost 21%, right? Current ratio looking about 5, which is really good, so they've got enough money, enough assets to cover their current liabilities. Now, in terms of valuation, in terms of growth estimates in the next 5 years, 10%, which is really nice every single year. In terms of valuation, simply Wall Street actually thinks is overvalued at the moment by 15%. Their fair value is $141 per share. Right now is $168 per share. And then when you look at Morningstar, it's saying it's fairly valued, $166 per share. Tip rank is about 10% upside, 179. According to Yahoo Finance, is 186, and it's a moderate buy according to Tip rank. Now, in terms of revenue, we're looking at about $15.7 billion to right now $19.5 billion, which is really good. 19.5, right? In terms of net income, 5.5 to right now 8.5. That's absolutely amazing. Even at COVID time, they still grew that net income. Free cash flow 6 billion from in 2018. Right now 5.8. So as you can see, it has a free cash flow has declined. Again, there's probably a reason for that, so you need to go away, find out a bit more. Is the company basically, is it because of the cost of goods that they're spending that free cash flow? Are they acquiring other companies? Whatever it is, something has happened, so you just need to see if something is, they might have a write-off or debt, but whatever, so you just need to look at that. In terms of shares outstanding, unlike the other company that we looked at, is actually been declining, and in the last basically every single year in the last basically 10 years, which is really nice. And the next one is a company that I own in my portfolio. This company is Qualcomm. I'm currently trading $128 per share. By the way, Qualcomm, if you don't know, it's a semiconductor company. Great company, honestly. I love this company, I'll be honest with you. I'm being very biased right now, I know, but I do like it. $128 per share, EPS of 11.29, market cap $142 billion. It has a wide and narrow economic moat, and I've always said this should definitely have, based on how many patents they've got, okay, this company should have a wide economic moat. 1.25 in terms of beta, which is quite high for me, so that means company is a little bit volatile, more volatile than obviously the market, if you like. PE is only 11, and the sector, we normally use, by the way, PE to compare with other companies in the same industry, and we compare it with the sector as well. Right now, when you do that, you can see this is 11 and this is 25.9, so that tells me is possibly cheap right now. In terms of 5-year average PE, 21, sorry, price to free cash flow, and we're looking about 21.77 as well. Okay, dividend yield, we're looking about 2.3, which is nice and sweet. Payout ratio only 23%, and 5-year growth rate of just 6%, which is fine. Dividend growth streak about 18 years. Dividend safety 80%. Free cash flow of $6.66 billion in the bank. Profit margin 30%, 35% operating margins. Return on equity 101%. Total return in the last 5 years about 9%. Current ratio above 1, which is very nice. In terms of growth, next 5 years they're expecting about 14%, over 14%. Simply Wall Street is actually saying 54% undervalued at the moment. Their price target is $278 per share. Right now is only 128. I wish that happens, because I do own about 20 stocks of this company. Morningstar 22% discounted right now. Their price is $163 per share. Tip rank is actually saying 48% upside and $190 per share, 187 according to Yahoo Finance, and it is a moderate buy according to Tip rank. Honestly, if that happens, I'll be very happy, man, right? So in terms of revenue, from 2018 we're looking about $22.7 billion to right now $42 billion. That's almost doubled in the last 5 years. That is ridiculously crazy. And the net income, okay, from minus $4 billion to right now $12.8 billion, and then $3 billion of free cash flow to right now 6.6. So they've doubled that as well. This is a cash machine. This is a great, crazy company. I don't know if they can keep up this type of growth for how long they can keep this up, but I hope this is true, because remember, these are analysts basically, and sometimes they could be wrong, just like everybody else. And in terms of their overview, in terms of shares outstanding, we're looking from 1.34 to right now 1.14. Okay, which is basically absolutely brilliant. So that means they're buying back that as well. Right, the next company is J&J. Is probably one of my best companies, the best companies in the world after Microsoft. Okay, I actually have more shares of this company than any other company in my portfolio. Currently trading handling at $65 per share. EPS just $6.88. $429 billion market cap, and it has a wide economic moat, and it has a very, very low beta. PE is 24, a little bit rich at the moment according to the sector. Is actually not that. So if you were interested in this company and you want to add to it, maybe you might need to wait. I'm sure the market will give us another opportunity based on what's been happening in the market in the last few weeks. You know, things can easily change very quickly, so you might want to wait for a little bit. In terms of the average, okay, you can see 17.7, and in terms of free cash flow, we're looking at about 21. So I'm sure it's a little bit expensive right now. So if you were interested, you might want to wait a little bit. Annual dividend yield of 2.73, which is really nice. Payout ratio only 43. 5-year growth rate of 6%, and 59 years of increase in this. This is another dividend aristocrat, dividend king, if you like. Dividend safety of 99%, and free cash flow of almost $20 billion. Okay, when the spin happens, we'll see how this company goes, but for now it's absolutely amazing looking at these numbers. Profit margin 19%, operating margin 21%, return on equity 25%, and 11% in terms of total revenue. Account ratio above 1, which is really nice. Next 5 years, they're expecting about 4%. 28% undervalued at the moment according to Simply Wall Street. $228 per share right now is $165 per share. And then according to Morningstar, fairly valued $167 per share. Tip rank is about 15%, 188. Yahoo Finance is also saying it's 188. Moderate buy right now according to Tip rank. Now in terms of total revenue, okay, $81 billion to right now $95 billion, and I've also included the cost of that revenue. Okay, it's growing a little bit, it's not a lot, which is nice. Companies like this, it just like is really good, because a lot of that money then flows back into the net income, okay, the bottom line of that. So $15 billion to right now $18.3 billion, and then free cash flow from 18.5 billion to right now 19.9 billion dollars, which is nice. And they are buying back their own shares. So the last 3 years they haven't done it, but the years before that they were actually buying back their shares. I'm sure they're going to continue doing that, and they obviously pay excellent dividends. So that is another outstanding company that I definitely would say look into it, inshallah. I'm not a financial advisor, but look into it and see if you are really interested. Some of you might say, because it's a pharmaceutical company, I don't like it. They got into all sorts of things back in the days. There's still some sort of ongoing situation with this company a while back. Now, that's up to you. I mean, I'm comfortable, and I believe this company is doing more good than actually harm to to everybody in the world. So that's my take on it right now. Right, so the next company we're looking at is Cummins. This company is an industrial company. They actually have, basically, they do a lot of diesel engines. They do power generators, powertrain components. So they are like the heavy duty truck manufacturer, basically. Okay, currently trading $214 per share, EPS of 14, market cap of 30 billion, and it has a narrow economic mode, and it has a beta that's almost to 1, PE 15, average PE is also 15, price to free cash flow 23. So when you look at the industrial sector, it's about 21. So that tells me it is actually trading cheaper in comparison to the sector. Right now they have almost a 3% dividend yield, payout ratio only 38, 5-year growth rate of 7%, dividend growth streak of 29 years, and dividend safety of 98, and $1.2 billion of free cash flow, if you like. Profit margin, we're looking at about 8 billion and 8%. Operating margin 10%, return on equity 24%, total return over the last 10 years we're looking at about 10%, and current ratio is above 1, which is nice. Okay, now I don't mind this, okay, because when you add the total, when you look at the profit margins, is normally I'm looking for 15, but this is a very old company, and where they are now and where I think in the next 5 years they can be, I'm sure this profit margin will increase in the next 5 years, right? In terms of next 5 years, we're looking at about 7.7, almost 8% growth every single year. And according to Simply Wall Street, they're saying 67% undervalued. This price, they're expecting the price to be $647 per share from $214. I hope that happens, okay? Morningstar, which I actually trust more than any other company because I think they're very conservative, they are saying it's basically fairly valued at the moment, $241 per share. That's more realistic in my opinion. Tip rank is 12%, 240, 243 according to Yahoo Finance, and it's a moderate buy. Right, in 2018 the company made $23 billion, okay, 23.5, 19 in 2020 when COVID happened, then it bounced back 24. Right now we're looking at $24.7 billion. Net income from $2 billion. It dropped quite a bit after during COVID time. Now it is kind of actually coming back again. And then when it comes to free cash flow, $1.5 billion to right now 1.2. So there was a decline and it's kind of coming back, but they are definitely buying back their shares, and they have a nice dividend. They are an excellent company. I absolutely love them. And just to be transparent, I do own, I think, 15 shares of that company and 27 shares of J&J. And finally, Qualcomm, I own 22 shares of that company. So I basically, those are the 3 companies that I have talked about today, right? All these companies are Sharia compliant. I haven't done the list, but every single one of them is actually Sharia compliant. There's no issues with these companies. Again, if you're interested in any of these companies, then obviously do a little bit of digging and find out a bit more information about these companies. I hope you have a wonderful day. Take care. Assalamu Alaikum.